So we are basically doing May, June 19, paper 23, and it is of marginal costing. So our first question is, what is meant by piecework payment? When the payment is made to employees, what is piecework payment? When is payment is made to employees on the basis of the number of units produced. On basis of number of units produced. So what is piecework payment? Piecework payment is payment being made to employees on the basis of the number of units produced. So that is called piecework payment. What is production overheads? Production overheads means factory overheads. So when I say it is factory overheads, means it includes all factory indirect costs. It will include all the factory indirect costs that cannot be traceable to production. That cannot be traceable to production. So that is called production overheads. Now I have a question over here, and they want us to calculate budgeted fixed selling expenses. So the first thing that I have to calculate is budgeted fixed selling expense. So when I talk about the fixed selling expenses, I see I have my revenue for the year, and the total revenue that I am getting is coming up to 171 plus 171 plus 186 plus 192. So the total revenue is 720,000. They want our fixed selling expenses. They want our variable selling expenses. So when I am talking about fixed selling expenses, the first fixed selling expense would be advertisement, and advertisement is 24,000. This is selling expense. Then our salesperson receives basic salary plus commission. So whatever is the basic salary is the fixed selling expense. Whatever would be the commission is based on sales. So when I say it is based on sales, that means it is variable. If sales will increase, the commission will increase. If sales will fall, commission would also fall. So if I talk about budgeted fixed selling expense, the fixed selling expense would be advertisement and salary, basic salary. So basic salary is 51,000. So budgeted fixed selling expense would be 75,000. This is C1. Now C2, they want the variable selling expense. So when I talk about the variable selling expense, it is just 3.5% of sales revenue. So it would be 3.5%. What is my sales revenue? It is 720,000. So variable selling expense would be $25,200. That is 3.5% of 720,000. Let's move ahead. They want us to find the total contribution. How do you get total contribution? It is sales minus variable cost. So I have my sales already, which is 720,000. less variable cost. Variable cost would be, it's just for 1 marks. So it is direct labor, direct material C, and direct material D. So these three things would sum up to the variable cost. So these are the variable costs. What is the total of the variable cost coming? 270,000 plus 48,000 plus 90,000. So the variable cost is 408,000. Sales minus variable cost would give me my contribution. But I have one more variable cost, that is the variable selling expenses. How much is the variable selling expense? It is 25,200. 270,000 plus 480,000 plus 90,000. 48,000 plus 90,000 plus 25,200. So the total variable cost is 433,200. So your contribution would be sales minus the variable cost, 286,800. Now, the next part that they want to know is the total budgeted profit. So I know my sales is 720,000 minus the variable cost is 433,200. I will get my contribution. My contribution is 286,800. From that, I will deduct my fixed cost. And when I'm deducting my fixed cost, I have fixed production overhead. 30,000. Or I have already calculated the budgeted fixed costs. That is, there will be fixed selling expenses also of 75,000. So the total is 75,000 plus 30,000. So the fixed expense is 105,000. So contribution minus the fixed cost is going to give me my profit, the budgeted profit, which is 181,800. Now go ahead. I need to calculate additional profit per order. Now let's read the question properly and see what are they asking me. There is Ethan who has received this order directly from a customer, and the order is for additional 15,000 pots at selling price of 8 per pot. 15,000 pots and the selling price would be 8 per pot. Order is to be delivered in November 2019. Information that is relevant to this order is that my existing labor force can produce only 70,000 pots. Additional temporary labor can be hired at $5.25 per unit. Current supplier can only guarantee material prices for maximum 70,000 pots. So if you want to have more than 70,000 pots, the supplier is not willing to give you the material. To purchase extra material C to produce any units in excess of 70,000, the cost will increase by 5% and cost of material D will increase by 2%. There is sufficient place in the factory to produce the order. They want to find out additional profit or loss made on this order. Okay, so my current capacity is how much? I need to check my current capacity. I will look at the question. Ethan is a factory, he makes hand painted pots. This is the budgeted information, and our normal selling price is 12 per unit. 720,000 is the selling price divided by 12. So 60,000 divided by 12. My budgeted sales is how much? Or budgeted capacity. Um, Budgeted sales is for 60,000 pots. It means my budgeted capacity is only 70,000 pots. And I am already producing how many pots? I am already selling. That means I am already producing 60,000 pots. Okay, now let's go ahead. My actual capacity. My labor force can produce 70,000 pots. My actual capacity that I am using, my current capacity that I am using is how much? 60,000 pots. And I have a capacity of 70,000 pots. And there is spare capacity of how many pots? 10,000 pots. But I have an order of how many pots? 15,000 pots. So I need 5,000 additional capacity to meet the order. Let's see. They want additional profit or loss. So my additional order is for how many units? Additional order is for 15,000 pots. My budgeted capacity is how much? My budgeted capacity is 70,000 pots. My actual capacity or my current capacity is how much? 60,000 pots that I'm actually selling. So I have spare capacity of how much? So I have a spare capacity of 10,000 pots. So how much is the additional capacity required? Additional capacity required is 5,000 pots. So whatever extra I am going to pay would be for 5,000 pots. So these 5,000 pots is going to incur additional variable costs. This 5,000 cost is going to take extra labor, extra material at higher price, material C extra at higher price, material D extra at higher price. Now I will go ahead with the prices that I have. Let's see. The sales will be at the rate of $8 per pot. So sales will be $8 into 15,000 pots. So how much will my sales be? $8 into 15,000 pots. So it will be for 120,000. less variable cost. What is the variable cost? Direct labor. For 10,000 pots, I have a normal labor, which is going to be how much? 270 is for 60,000 pots. So direct labor cost will be 270 divided by 60,000. So it's going to be $4.5. So for 10,000 pots, it is all going to be at the rate of $4.5. And for the additional capacity of 5,000 pots, my labor cost will be 5.25 into $5.25. So this direct labor will be 45,000 for normal capacity, 26,250 for additional capacity. So total direct labor cost will be 71,250. Now let's go ahead. Variable cost. One is direct labor. One would be direct material. Direct material for 60,000 units of material C would be how much? 48,000 divided by 60,000. This is 0.80 per pot for material C and 0.84 per pot for material D. Now let's go ahead. The direct material cost. Material C. Again for 10,000 units, it is going to be 0.80. And for the 5,000 units, it is going to be how much extra? For 5,000 units, material C would be 5% extra. So it is 0.80 into 105%. So it will become 0.84. For material D, 90,000 divided by 60,000, it is coming up to 1.50. So material C costs for 10,000 units, it will become 8,000. And for additional, it will become 4,200. Total is 12,200. Material D. Same thing. For 10,000 units, it will be different. And for 5,000 units, it will be different. For 10,000 units, we are going to be charged at a normal price of $1.50. And for the additional 5,000 units, it is going to be $1.50 into 102%. 1.50 into 102%, it will give you $1.53. So into $1.53. So this will become 15,000 for material D and 7,650 for material D extra units. So the total is coming up to 22,650. Sales minus the variable cost would give me the profit. This is the budgeted profit for additional order, the additional profit or loss for this order at $8 per unit. Advise Ethan whether or not you should accept the order. Justify your answer taking financial and non-financial factors. So I have to give whether I should accept this order or not. For financial factors, I have to give 2 points. And for non-financial factors, I have to give 2 points. First thing, financial factors, if I accept this order, you should accept the order because it is leading to a positive contribution. That means the sales minus variable cost is positive. There is a positive contribution of 13,900. So it will increase the sales revenue. So financial factor directly tells me that it has a positive contribution. It will increase the sales revenue, but you have to see impact on fixed costs as well. But impact on fixed costs needs to be considered. Needs to be considered. Now, if you see the non-financial factors, if I see the non-financial factors, my normal selling price is how much? My normal selling price is $12, but I am selling it for $8. That means if my existing customers come to know that I am selling at a lower price, the existing customers will get demotivated. The temporarily laborers are going to be paid at a higher rate than our normal laborers. So our laborers will get demotivated. Okay. If I produce extra, I should take into consideration that if I'm producing extra, the quality of the product of the pot is not getting dissatisfied. As far as the financial factors are concerned, you can't accept the order, but you should keep in mind that your customers, other customers, do not come to know about this special arrangement. That is it, what you have to write. 2 benefits and 3 limitations of using cost volume profit analysis. What is cost volume profit analysis? Cost volume profit analysis is your break-even analysis. So you have to give 2 benefits and 3 limitations of using cost volume profit analysis. When I'm talking about cost volume profit analysis, it means your break-even analysis. So 2 benefits of break-even analysis that it helps you in your short-term decision making. It identifies the break-even point. That means I can say it identifies that point of sales where you make no profit, no loss. Your break-even analysis helps you identify your margin of safety. That means how many units you have sold over and above your break-even point. But the limitation of your cost volume profit analysis is it assumes that fixed cost is always going to remain constant. It assumes that variable costs per unit are the same over all the period of time. And it also assumes that the selling price per unit remains the same. You can just keep these things in mind and memorize it. So your break-even analysis or your cost volume profit analysis helps you for short-term decision making. It identifies the break-even point and margin of safety. Disadvantages: it assumes that your fixed costs are constant. It assumes variable price per unit will remain the same. And it also assumes that the selling price per unit will remain the same. Sometimes the more limitation of this is that some costs are very difficult to identify whether it is going to be fixed cost or the variable cost.